A skill everyone should have is financial planning. While setting investment goals may seem easy, when it comes to actually doing something about it, many of us fumble because we don't know where to start, or we don't know what the right path is. It all starts with knowing what really matters in your goals. Do you want to find out the rest? Stick around. 1. Know what matters to you. Before you start investing, it's important to know what goals you've got. For example, do you want to buy a house within the next year, pay off tuition fees, save up for retirement, or something else along these lines? If so, focus on building up money for that before you put money into your investments. Identify what your financial goals are, and if investing aligns with them or not. Use the acronym SMART to set your goals. The goals should be specific, measurable, achievable, realistic, and time-based. 2. Group your goals depending on how long they'll take to be achieved. Once you've got your goals listed, having used the SMART method, you'll know how long each goal will take. You should now group your goals into 3 categories: short-term, medium-term, and long-term. Short-term goals are likely to take a year at most to complete. Most of these goals require little to no money. The medium-term goals may include learning a new skill, getting a new job, starting a new business, paying a down payment for a house, or starting a new career path. Unlike short-term goals, these goals take longer to finish and require a substantial amount of money. The final category is long-term goals. This is what comes to many people's heads when we talk about investments. Normally, most of us would think about retirement, saving for a child's college fund, or becoming our own boss. Long-term goals normally take years to accomplish, but with the right saving plan, it's a breeze to get to the finish line. 3. Choose investments that align with your goals. Now, you need to identify the right investment plan. For short-term goals, high-yielding saving accounts or the money market fund are what you should use. You won't be making a lot of extra cash in these types of accounts because the rates aren't usually that high, but at least you'll have your money whenever you need it. These accounts have very low investment risks, which means that they are perfect for goals that will take a year or less to accomplish. You could also choose to put your money in a savings account, but know that money won't grow in it. When investing in goals that could take 5 years or more, so medium-term goals, you should consider taking more risks depending on your overall risk tolerance. If you want to earn better returns, you could allocate small amounts of money from your portfolio to a high-quality stock through an exchange-traded fund or ETF. Normally, this would work best for those with a high risk tolerance, because sometimes the high-quality stock loses value. If you don't have that much to lose, you could take a look at money market funds or high-yield savings accounts. A long-term goal such as retirement will need a different plan. Due to the nature of these goals, they usually give one ample time to make up for any losses incurred over the years. This is the main reason you should use stocks when investing. Investing in stocks is as easy as it sounds. You could use an online broker to get the job done. I would advise you to invest in different securities so that not all is lost if one investment goes down the drain. You can also invest in a basket of stocks through mutual funds or ETFs. Do this with caution, as sometimes you end up paying fees that are too high for that particular investment. An easier way to do it is by using target date funds. This is a perfect fit for retirement investment or saving for your kid's college fund. Usually the year that the goal is expected to be attained is written on the labels for these funds, and those funds are then invested with that time horizon in mind. 4. Consider how much you're willing to risk. Most of the time, your investment plans will either increase or decrease depending on how willing you are to take risks. Therefore, before making any investment, you should consider how much risk you'll be taking, as well as the bills you have to cater to. You wouldn't want to have a very high risk at bay when you still have kids to look after, house bills, meals, or repairs. The best way to cut your risks in half is to not risk more than 4% or 5% of your entire portfolio. That means if you're risking 4% of a $100,000 portfolio, you're limiting your potential loss to only $25,000 on each investment. 5. Mix it up. Build a diversified portfolio. We all know the saying that goes, never put all your eggs in one basket. Investing in certain areas can sometimes have very promising results, but it's never a good idea to invest it all in one area, regardless of the outstanding results you're expecting. Sometimes it might not go as planned, so the trick is to have a diversified portfolio. Invest your money in different areas so that when one fails, another still prevails. The economy, interest rates, politics, wars, and even weather can all have an impact on an investment. Making a balanced, diversified investment portfolio is one of the best strategies to guard against the market's ups and downs. 6. Set up an investment workflow. Creating a plan of action is one of the best ways to succeed in investing. Occasionally referred to as a workflow, this describes your process for saving and investing. The workflow will be more challenging to adopt without clear goals and objectives. Before you get to this stage, you'll need to have known what matters to you and have already grouped your goals according to their time of completion. Everyone has distinct circumstances, including different needs for retirement, different family arrangements, and varied costs of living, which is a key lesson to be learned from the discussion of investing workflow. You'll need to assess your individual circumstances using a variety of pieces of information before deciding what will work best for you. A flexible and adaptable plan would typically be referred to one that has to be changed completely or at great expense. 7. Determine how much you are to invest. Sometimes we tend to start working blindly without first assessing how much we'll need to invest in what. I understand that it's easier to do it without considering the price to avoid the stress, but knowing the exact amount to invest should always be the first priority. By determining when you'll need the money, you may calculate how much you need to save each year to meet your financial targets. When it comes to retirement, the response is usually as much as feasible. However, for more specific goals such as education planning, you can reverse engineer the amount you have to save, whether you begin saving at a child's birth or another year in the future. It really doesn't matter when you start saving, but the point is that when you know how much to invest in the time you have, you will be a step ahead. 8. Regularly do investing goal check-ins. Now that you've done all that and have started investing, you'll also have to make sure that you check your investment goals regularly so that you know where you stand. It's understandable for goals to change. Sometimes, that's why you need to look them up and change them where necessary. Typically, medium-term and long-term goals become short-term as time passes. So when you reach this point, you should reconsider your investment strategy. If we're being realistic, what's the point of having all your money in stocks if you've got a year to work before you retire? By doing regular check-ins on your goals, you'll definitely have your portfolio in order since you'll be adjusting it where necessary. Knowing your investment goals is always the first step towards successfully achieving them. All you need to do is meticulously think through what your short-term goals, medium-term goals, and long-term goals look like, and begin investing depending on the time frame. Remember to also know how much you'll need to spend on each goal, so that it never hits you as a surprise. If you maintain proper discipline and stick to your investment plan, I think you'll be all set on your journey. I won't guarantee that it will be easy. The road will definitely be rocky, but if you follow the steps I've told you with a clear-cut vision, you'll be a pro at investing. Well, folks, thank you so much for watching. Have a great day, and I'll see you in the next one.